On today's show, 3 questions. Number 1, what is the bond market telling us? Number 2, where are all the TikTokers going? And number 3, is the S&P 500 actually diversified anymore? Welcome to Dentist Money's 2 cents, where we help dentists navigate all the noise. I'm Matt.
I'm Jake.
And I'm Robbie.
Dream team, back at it again.
What's up?
Guys, quick question. What is the statute of limitations on Happy New Year?
Oh. I heard January 15. Beyond that, it's illegal to wish someone Happy New Year, right?
I think the first
I
week.
think it's probation, yeah.
The first week, really? After that?
Yeah, you think first week? I say 2 weeks. I think 2 weeks into the new year, you're good. I think after that, it's just kind of like, no, we're in it, guys. We're in it. But that's stupid. Maybe that's dumb. Maybe it's the first quarter. I don't know.
No, it's not the first quarter.
It's not the first quarter.
Not into February. No.
You can't go into February anymore. Yeah. No, you can't. Okay, I just was curious. You guys are not saying it anymore. I'm not saying it.
I never really say it.
I say it like the first few days, and then I'm kind of like, okay, let's move on.
Yeah.
The second question on this really quick, though. How long does it take you to write the proper year on any form or anything you're filling out? That's for me until like
a
June.
While. Yeah, it's a while.
Yeah.
Actually,
by the time I adjust to the
anymore.
new year, we're on to another one. Robbie, you don't have that issue?
I had that issue back in school when you had a pen and paper, but now on a keyboard, it doesn't bother me.
You're not writing checks anymore?
No, not writing checks.
Okay. Hey, let's jump in. Robbie, what is the bond market telling us?
Yes, so...
To which Jake said, we're talking bonds today?
We're talking bonds. The reason we're talking bonds is because there's more stuff happening in the bond market than the equity market. The equity market has been data dependent. It goes up when, inflation numbers are low, and it goes down when like unemployment comes in low and like the job market is hot. So we haven't had much. This week has been a very strong week for equity markets. So it's the best week since November. On Wednesday, the stock market posted its best day for the year. I think I have something to do with that. It was my birthday, so you're all welcome.
Thank you. Thank you.
Happy birthday, Robbie.
Thank you. And yeah, not much. It's all reactive in terms of the movement the stock market is doing it. There's no signaling happening. However, the bond market has a completely different story. So let me walk you through it. I'm like really excited for this. We have been experiencing something called a bear steepener, which it means, we've covered it multiple times, what it means, the yield curve is steepening, aka the yield that you see on 10-year bonds is getting much higher than the yield that you see on a 2-year treasury bond. For a while, it was inverted, and they say, oh, the yield curve is inverted, this is a recession indicator, etc. When it steepens, there are 2 ways it can steepen. It can steepen because the 10-year is going up while the 2-year is staying where it is, which is called a bear steepener. That's usually a negative reaction. Or it can steepen due to something called a bull steepener, where the 10-year stays where it is, but the 2-year drops. So the Federal Reserve cuts interest rates. Bull and bear doesn't say that, oh, the economy is going to do well. Bull and bear just means bond traders are going to make money or lose money. So it's an indicator of whether it's positive for bond traders. It's not an indicator whether the economy is doing good or doing bad. On the contrary, in the situation that we are in, which is called a bear steepener, we have noticed that the 2-year hasn't been changing because the Federal Reserve has paused interest rates, but the 10-year has been increasing. And since September, guys, the 10-year yield on the treasuries have moved from 3.6% to 4.6%. So we had a full 1% increase in the 10-year bond yield in just the last 4 months.
Hey, Robbie.
Yes.
Really quick, just so people can understand, when you're quoting these prices, right? Because there's two categories of treasuries, right? There's primary issued treasuries. Mm-hmm. They're issued by the government every month, every 2 weeks. That's the primary market. And then there's the secondary market that are being traded out there in the market. When you're quoting these rates, what are you speaking about?
I'm talking about the secondary market. And we really do not give a lot of attention to the primary market because most of the time it is really well bid. Primary market is when the treasury, like the actual treasury of the United States, lists these bonds on the market for the first time and says, this is the price or the yield that I'm willing to sell them to you at and raise money at. Usually they're really well bid. All countries around the world still love US treasuries. They want to hold them. And it's just the price that the US asks for gets cleared. And that's what happened. But later on, as bond traders within themselves start exchanging these bonds, and this is where we call it the secondary market, the interest rate starts changing. And the interest rates as a big indicator of what market expectations are going to be.
So that's why I'm glad we clarified that, because I think that gets confused sometimes and people are like, why do we care? Like, what, Robbie, you're always talking about treasuries and why does that matter? This is why it matters, right? Because it's an indicator of supply and demand. And when people, and if you wouldn't mind, Robbie, just taking maybe a second, when people talk about the inverse relationship between prices and yields, like what does that mean for people? Like there's this talk of when prices go up, yields go down and vice versa. Can you just break that down briefly for people to understand? So we're talking secondary market, bond traders. When people talk about this relationship, I guess, why does it matter that we care about where yields are and prices are in the secondary market?
It is a broad indicator, but also those interest rates that we are implying from prices, and I'll get into this relationship in just a second, carry over and, affect equity markets and the prices of houses and the prices of stocks and the prices of all financial assets. So interest rate, like the one that is related to a certain time period, is the same across all different assets. Whether it's a stock and you're seeing the dividend that might happen in 10 years, or a house and you're seeing whether the rent that's going to be happening in 10 years, or a bond with its coupon that's happening in 10 years. All of these have the same interest rate at the core, and then you add a little bit of risk here and there on top of it. But there is a core element, and that core element emerges from the bond market. So what happens? People do not go into the secondary market, aka they're trading bonds between one another, and say, oh, I want this interest rate. No, we know how a bond is priced. A bond says, hey, pay $100 right now, and then in 5 or 10 years, you're going to get that $100 back. But every single year from now till then, you're going to be receiving 5%, which is a 5% coupon bond. This is what we know. There is no mention to interest rates at all in this conversation. It's a 5%. You're paying $100 now. You're going to get it back in 10 years, and you're getting $5 every single year in between. Where is the word interest rate in this sentence? There isn't. But mathematically, simply because we know that it's like mathematical, it really emerges from math. The price is literally those coupons and that future payment of $100 discounted back, aka it is divided by a certain interest rate to make sure that money has a value across time. $100 today is not the same as $100 tomorrow. And the difference between those is the cost of this money throughout time. And that's what we call interest rate. So when they're saying you pay $100 right now, you get it back in 10 years at $100, and there's 5% interest in 5%, $5 payments throughout in between, this tells us that the interest rate is 5%. But if you pay maybe $107 right now, but you're only going to get $100 10 years down the line, but you're going to be getting $5 in between, it'll tell us that interest rates are probably much lower than the 5% that you are getting from the bond. As you start running those numbers, you notice that when interest rates go up, the price of a bond goes down. So you pay maybe 97 or 95 in return to getting 100 later on. But when interest rates are low, you pay 102, 103, 105, depending on how low they are. So the inverse relationship between interest rates and bonds emerges mathematically. This is how we make sure that we are consistent and logical. The value of the $1 today is not the same as tomorrow. And this carries over in how we're going to be pricing the bond. We're going to change the current price of a bond depending on what interest rates are.
Yeah, that makes sense. Jake, any thoughts or follow up on that at all?
No.
I just wanted to clarify. Academic.
No, I love that. I just think people misunderstand the bond market a lot for good reason. It's a big, scary thing. It's way bigger than the stock market, but the only people that kind of play in this space are institutions, basically. You have very, very few, I mean, they're out there, but very few individuals that mess with the bond market. It's big, it's scary, people don't understand it, but I thought it was really critical to understand that relationship but can I just summarize back to you, Robbie, in my very average brains, like kind of like break it down for the average person of saying, when there's a bond out there paying you a certain dollar amount based on an interest rate, as the interest rates change, right? So if that bond's paying you $5 or whatever, but I can go get another bond now that's paying me $6, why would I pay the same amount of money for the $5 bond than the $6 bond? So the $5 bond, the price has to come down for it to be equivalent. It's just basic math. Okay.
Yes.
I'm glad we were able to kind of break that down. Sorry to knock you off, but nothing knocks you off. But I wanted to make sure we took a step back on that. So go ahead, Robbie. Continue down the road, Robbie.
Where were we? So we were talking about the 10-year, and we said that it moved from 3.6% to 4.6%, a 1% increase, which means if you want to talk about it in terms of the bond prices that we were just mentioning, probably people were paying $97 to get $100 10 years from now, but now because interest rates have gone up by 1%, they are probably paying maybe 95. The interest rates went up, the price of the bond went down. So what does this indicate? We know, and we've covered this multiple times on the podcast, the long end of the yield curve, aka the 10-year yield, the 20-year yield, those far away in the future are completely controlled by supply and demand, and they're not controlled by the Federal Reserve. So looking at how they move can indicate one thing or another for us. And when the 10-year interest rates goes down, market participants are probably expecting a recession. They expect the Federal Reserve to come in, cut interest rates across the board, so they are getting ahead of themselves, already pricing it in, if their probability of a recession is high. But when the interest rates for the 10-year go up, just like in the case that we've seen, market participants are expecting either really strong real economic growth or inflation, because you can't really separate growth until after the fact, after you've seen whether that growth was inflationary or actually solid, right? So it's going up, and the market in its mind, bond market, not equity, is signaling that there is future growth. It might be inflationary, it might be not be, and it's giving off a signal. So they are more on the camp that there's no recession in the books. This is the first indicator that we're seeing from a bond market. Interest rates, 10-year are going up. They do not think rates are up.
Hey, Robbie, could this just be as simple as this could be something as simple as saying people are selling bonds to get into like equities, which is driving the price down, which means yields are going up. Could it be that simple?
Could be that. And it could be they're just moving to other bonds.
To different types of bonds with different risk structures.
So you will not be able to know where they're going. If we knew where they're going, we'll be making so much money. But we know that they are selling bonds. That's
Robbie knows where they're going, but he's not going to tell anybody.
He's not going to tell you.
So like Robbie's a billionaire.
Oh, I wish. So here's the most interesting thing. And I got you guys data about the interest rate and back in 2023. So back on October 19, 2023, the 10-year interest rate, the one that we are looking at right now, went all the way up to 4.98, which is 5%. The 10-year yield went up to 5%, which was the highest in quite a while since the Great Recession. But at that time, the federal funds rate, the rate set by the Federal Reserve, was between 5 and 5.5%. You would say, yeah, the market's trying to be flat. The target rate is 5%. The Treasury the 10-year yield is getting at 10-year. It's telling us that at 5%. It's telling us that there isn't really much a slope upwards or downwards. We're in a type of equilibrium between quotations. But right now, the federal funds rate is 4.5%, right? We have dropped 1%, and the 10-year was still able to get, as of now, well, today they dropped, but as of what we looked at, it was 4.6%, which is only probably a little bit below the 5% mark that it is. So what we are saying, we move to a new macroeconomic environment where interest rates are lower, but the ones set by the Federal Reserve are much lower, but the 10-year is still maintaining a very high level, indicating future growth or future inflation. The most interesting part about it is that what we're saying, a bear steepener, aka interest rate, the yield curve is getting steeper. It usually happens after recessions. It doesn't happen once you've come out of a situation where you've got the Federal Reserve fighting inflation. This is very, very, very rare. When interest rates are high in the 4 and 5%, the yield curve does not steepen. It only usually steepens once the interest rates are like at zero and people are expecting growth. So the fact that we have an elevated level of interest rates, but at the same time, and when I mean elevated level of interest rates, like the rates set by the Federal Reserve, the short-term ones, the 2-year, the 3-month, etc. When those are high, you do not expect the rest of the curve to steepen, but we have seen it. And it's
interesting.
we haven't really seen it for only like, I went through the data. I was like nerding out on it yesterday. We've only seen it for a couple of months in the 80s, but that was it. So this is something that is very new as a phenomenon in the bond market, where the yield curve is steepening even with elevated interest rates. So it's a mixed signal. But if we really think of it, this is the first time as, civilization, or a country, we've tackled inflation without putting the economy into a recession. So economically in the playbook, we did move to an uncharted territory where for the first time ever, we were able to reduce inflation, maybe not 100% where we wanted, but reduce it significantly without putting the economy into a recession. And the bond market is reacting to this new piece of information by showing us a phenomenon or an observation in bond yields that we haven't seen before. So this is what is interesting. It kind of really, just to bring it back home to, after all these technicalities, to like a long-term investor, the bond market is literally telling us that they are at an uncertain time. They have yields that are elevated that should put your economy into a recession, right? Interest rates are high. That's 4.5% compared to the 2 and 3 we used to see a couple of years ago. But at the same time, the yield curve is steepening, which is an indicator of growth, regardless of what type of growth, whether it's inflationary or real, it is showing up there. So there's a mixed message, which is an uncertain time. And probably most of the time, the best time to invest is when you take on this uncertainty from other people, because you're going to be getting rewarded for that risk. So history is not repeating itself. It is rhyming. We've seen yield curve steepening before. We've seen high interest rates that might be getting cut by the Federal Reserve, but this is completely new. And this is causing uncertainty. This is why we're seeing a little bit of volatility in the equity market. Like the move has been a 1.5 up, 1.5% down instead of the usual 0.5 up and down.
Because we're dealing with something we're not used to.
We're not used to. And the 10-year has moved from the 3.6 to the 4.6, while the actual target rate by the Federal Reserve is still at 4.5%. So all of these are just, it's not saying that there's something broken. On the contrary, but it is evolving in patterns that we haven't seen before. Yeah. And this is just an indicator of the uncertainty, which tells you it's a prime time to invest, because going through the uncertainty is what creates returns.
Am I the only one who's sitting here thinking, like, when I hear you say, Robbie, we were able to do this without causing a recession, and now look where we're at? Am I the only one that has just a little bit of like, yeah, but what's the cost we're going to eventually pay of that, like, for this?
I was going to say that exact same thing, Matt, is like, oh, we're kind of celebrating a little bit right now. And then it's, oh, what's the next shoe to drop, or what are the consequences going to be if this was still, inflation's going to ramp back up here? I know it has gone up, right, a little bit. Anyway, yeah, I was thinking the same thing.
Yeah, I don't know what it is. I sit here and think like a fundamental like truth of whether it be like progress in your life or when it comes to the markets, or I think a fundamental truth is like you don't get progress without pain. And so I'm kind of like, we're basically saying like there's been very little pain to achieve this progress and it's going to continue. And I'm like, just a little piece of me, I'm not a doomsdayer. I don't believe in that crap, but I am sitting here just thinking like fundamentally like, okay, but we can't avoid the pain. So like, are we just delaying it? Are we just pushing it out somewhere? Is there somewhere we're missing like this idea, Robbie, you're saying this phenomenon of like this bear steepener usually coming, and very intuitively, like usually would come post a negative event, and we're growing out of that pain. And we're saying, well, we haven't had the pain, we're getting the growth. I'm kind of like, ooh, well, what does that mean? I guess I'm asking that, what does that mean?
Yeah, there are two ways to look at it. There's that, it's not as doomsdayer, but it's like, it's not supposed to happen here. Interest rates are still high. Is the market really lost? And we're going to stay lost until we have data and actually have, sharp direction in one way or another and take a pain. Or you can, and my view is more optimistic of that, it's the first time where we were able to control inflation without putting the economy into a recession, which means we were able to control inflation without having to push ourselves to lower interest rates to stimulate the economy after the work that we've done. So by controlling inflation, we moved to a new equilibrium in the economy. We moved to an equilibrium where the normal interest rates at which we run at are 2%, to a new equilibrium where the normal interest rates that do not affect anyone are at 4%. And from this new equilibrium, the market is optimistic about a future, whether it's through the new administration or the new technological advancement. The reasons are many for bulls in the market. And we have chosen a new starting point where, the labor market is in balance, inflation is under control. Why isn't this a new equilibrium to start with? So maybe the pain is that mortgage rates are not going to cut down.
I was just going to say, maybe
Not
people
happening.
are out there, no, they're not. But maybe people are out there saying, what are you talking about, Matt? Like, we've been feeling the pain for the last several years of inflation. Like, it's just a different pain. So that's fair. That is totally fair. I guess I'm more just saying recession level pain. And I guess if we're talking stock market, different than the economy in a lot of ways, it doesn't represent lockstep. But if we're talking, 2022, we had a negative 19% on the S&P. So we've had some pain. So I need to check myself here and say, it's not just been sunshine and rainbows, but just more of recessionary issue. I hope that Jake's not, he's maybe it has been. Anyway, so I just want to acknowledge that there's people out there being wait a second, what about inflation? That's massive pain. Jake, you have thoughts on that?
No, yeah. We've had some pain. Again, the inflation thing is still sticking around a little bit. Again, we've got it under control. This is the one hard thing to grasp about inflation is that, yes, prices of things have gone up a lot over the past couple of years. When we say we've curbed inflation, all we're meaning is we're just slowing down the speed of the growth, right? We're not saying we're going back to 2019 prices. We are just saying we've stopped things from growing at an 8 to 10% rate per year, right? We've curbed down to, the typical 2 to 3% average basket of goods type of thing. And so that's always, you always have to caveat that if people think when they say you curbed inflation, they think, well, my prices haven't gone down. Well, that's not what we're talking about. We're just talking about prices not growing at a crazy pace anymore. So people still feel the pain there. The housing market, yes, I don't, trickle down here with interest rates in the housing market. Still remains stubbornly high. I mean, I know we can talk about this, Robbie, but I know some people have changed their predictions or we're not even anticipating that big of rate cuts anymore this year, just with how the economy is going and things like that. And so I think people still feel the pain in those two areas of oh crap, housing is still really expensive and my eggs at the grocery store are still expensive. So that's the pain I'm feeling.
Yeah.
Anyway.
Well, and to that point, Jake, housing is a great example. Housing prices have stagnated. It's not like we're seeing these massive growth or years. And in some cases, they've actually come down slightly, but they're not going anywhere. They're not going to drop through the floor, and interest rates are not coming down anytime soon on the mortgage rate. They're just not. And so I guess maybe that is a little PSA for people. If you're out there, be I'm just going to wait. I'm going to wait because prices are coming back down. Mortgage rates are no, they're not anytime soon. So you got to think about other things if you're going to buy a house. Okay, Robbie, anything else on the bond market?
No. I like how you said it at the end. It's stuff are not going anywhere and those who are waiting might not see it materialize. What the bond market is telling us is stuff are not going anywhere, but where do we go from here? And what it's saying more growth. So probably more growth with prices that are as high.
So that means be scared.
Yeah, be scared. I was actually just speaking of that. I have two people very close to me who are custom home builders. And I was talking to one of them yesterday and he was just giving me his experience of what's happening. And man, it's kind of just slowed. I think people are just waiting for stuff to come back down. And I said, this is just my thought. I'm not saying this is right, but I'm I think instead of waiting for prices to come down, you have to wait for psychology to catch up. You need people to readjust their expectations. For example, it was not that long ago that mortgage rates were in the double digits. My dad's been in real estate for 4 years. He's I remember when I was doing stuff in real estate at 16, 17% mortgage rates. They come down from there to 6%. It's everything's on sale. Right now, the psychology is because we're coming from the lowest rates we've ever seen to 6%, everyone's freaking out. Psychology has to catch up on the mortgage, and I think it will. I don't know when, but things will readjust. People are going to readjust to the new normal, anchor to the new normal. Housing will pick back up. It'll be fine. Okay, moving on from bond market to TikTok. This is pertinent.
From the smartest people.
I am not a TikToker.
Do any of us have a TikTok account?
I do not,
three?
never,
I do
not
not.
Okay,
ever.
so we're the experts here.
Yes, so we are the experts on TikTok. I have seen videos from other people who have TikTok. I know TikTok is the most, at least as of recent data I've seen, like within the last few months, the most used social media app, but it's not even close. Like, I think it's like 4 times the other ones. And in fact, I think I saw at one point, this could be wrong at this point, like meaning the data could have changed. But I know at one point, the average use of TikTok was the average user on TikTok spent more time on TikTok than Facebook, Instagram, and Twitter combined. So TikTok is heavily used, but the TikTokers, who are not us, clearly, are freaking out. And the reason they're freaking out is because as of this morning, so this will come out tomorrow, Saturday, which Saturday is what, June, January 18th. So it'll come out January 18th. As of January 17th, just this morning, the Supreme Court upheld the basically the attempt by TikTok, and I guess it's subsidiary, the company that owns it. They were making an attempt at First Amendment rights violations, basically saying you can't ban this in America. It's a first right violation. And not one dissenter in the Supreme Court, all 9 judges said absolutely not. This is not a first right issue, and they upheld the ban. TikTokers are freaking out. Basically, right now, what they're saying is there's a lot of coulds. There's a lot of coulds being thrown around. Like, this could be upheld. This could be banned. There's a lot of things that could happen. It's still things very up in the air. But as of right now, what is happening is they're basically saying one of the main options is, and what they're trying to force is a sale of the U.S. kind of subsidiary portion of TikTok. And the reason for all this, for those of you that don't know, I think most people listening probably do know, that TikTok is owned by China, or owned by a Chinese-controlled company. Apparently, TikTokers don't care about this. It is an open secret that China is stealing your data.
Yeah.
People don't seem to care. So much so they don't care. You ready for this, guys? So much so they do not care that now what is happening is, in response to this, TikTokers are flooding to a Chinese-based social media company called Redbook. If you go Google Redbook, it is the number one, not even close now, it is like far and away, the number one downloaded app in the world. It is like tripled over the last week. People are flooding to Redbook. Why not going to just Instagram Reels or something? Make it make sense for me, guys. I have no idea.
I don't know either. I've talked to my wife a little bit about this. She's she's on social media. She has Instagram Reels. She does TikTok. Most people do. But apparently Instagram Reels just isn't as fun or as funny. Like, it's more of like this is what I've heard, is it's more of it's like influencers are on Instagram more, and it's more curated content. And like the TikTok is more just anything goes, wild, wild west. I'm getting videos from everywhere, just more funny, entertaining content than like what's getting sold to me on Instagram. I don't know. That's what I heard from sources, which are my friends.
Sources of TikTok. Yeah. So a couple of things here. And again, I guess I'll back up really quick. Other things that I'm reading that are saying, so here's my take really quick, hot take. I don't think TikTok's going anywhere. I think it's going to get saved one way or another. I have no reason to believe that. Chalk it up for like things I believe I have no backing to. I just think now Trump's coming out basically saying, starting to like, I think Trump's going to try to save the day, be the savior of this. He's made comments about it recently, kind of like having some positive vibes with TikTok, talking very positively about it. There is a little bylaw here that I guess he has the right, people have already uncovered, he has the ability to at least suspend the ruling or the execution of this law for at least 90 days. So if they can't sell this by the weekend, which literally is like as you're listening to this, there's a possibility it gets banned. But I guess Trump has the ability to push this off another 3 months. So there's a lot of things that could happen here. Robbie, I'm going to get you in here and get your thought.
The first thing that caught my attention is the fact that creators are flocking to another Chinese app. I wonder whether, I'm thinking of it from a business model perspective, I wonder whether the compensation package for creators is just more attractive doing business with the Chinese than it is doing business with Snapchat and Instagram. And that's why people are just trying to, get a big cut.
What I've been told from sources close to the situation, as they say, the fellow TikTok users, I, again, have no idea. I'm just going with people that are on it. What I've been told is that for whatever reason, There is a super anti-Instagram. Jake, you're alluding to some of it, but I think it's actually more like anti-Zuckerberg, against the billionaire man. We're not going to go to Instagram. This is what I've been told, that a lot of TikTokers are rallying each other like, don't go to Instagram, go to this red book. There's a whole other issue there that I won't get into and make it political, but
people want their data stolen by the Chinese and not by Mark Zuckerberg. Apparently, it's the decision they're making. I don't know.
Your data's getting stolen by someone, so it's getting used and stolen by someone.
I think, Robbie, TikTok does pay its creators better than most platforms. I think, like, more than Instagram Reels or other things. I do think that actually is a factor here.
Yeah.
Is where all these creators and people going if TikTok goes down or changes. I don't know.
Last thing on this, and we can get your guys' final word. We can move on. This is a quick one. I just thought it was, because it just happened, and it's a big deal for people. I bet there's a ton of people listening
it's a big deal.
Are on TikTok. It's a big deal for social media stuff. What I am a little surprised by, and maybe I'm just not understanding how any of this works, I fully admit that, but I am shocked. This has been in the works for years. There's been rumors and talk of this for a long time. I am shocked a U.S. company has not been able to take advantage of this and build like the exact same thing.
Yeah, just make the same thing. I have no idea.
But maybe I am just, again, not understanding. Maybe the people are out there being like, it's not that easy. It feels like it could be that easy. Like, you have the formula, just go build a TikTok, but in America. But again, I think there's probably TikTokers that are kind of like cult-like with TikTok. I have no idea. Robbie, any final thoughts on this?
I don't know. I don't understand that business model. I'm really excited to see how it will pan out. I saw a Instagram short of Mr. Beast saying that he wants to buy TikTok. So we'll
saw this. So Mr. Beast has been in the works. I know Elon has made comments, and then Zuckerberg has been going after it, I think, for a while. But there's apparently a big, believe me, I'm neutral on Zuckerberg. I don't know I have no opinion on him. But apparently there's a huge anti-Zuckerberg push of where, so far, apparently it's like ByteDance or something, which owns TikTok. Like, that's the back company.
Sure.
They've been pretty clear, like, so far, maybe they're playing a game of chicken, but they basically said, like, we're not selling this. We're not like letting you bully us, basically. They've even made claims of, like, if this goes through by this weekend, TikTok in America is gone. Like, they're just going to cut it, is what they've said. Who knows? Maybe they turn. Who knows? I think they're going to get it figured out. There's way too much money in it, so it'll be interesting. But Jake, any other thoughts as a big TikTok guy?
I'm not a big TikTok guy, but I am curious to see how it plays out. Would it be interesting?
Yeah. Okay. Last thing, Jake, is the S&P 500 actually diversified anymore?
Okay, good question. Let's talk about it. We can somewhat segue into this of. I still think with the TikTok, whether it goes away or not, I do think a lot of people get their financial advice from TikTok or Instagram Reels or CNBC, whatever short form platform you use for like your short form general financial content. I mean, that's a growing space, right? It's like FinTalk, whatever you want to call it. When I see these short form videos, I don't know about you guys, but I see a lot of, the people who are trying to do good and tell people how to invest their money. Invest in index funds is a very common phrase now. Like, that's really popular. Like, hey, instead of day trading or picking stocks, that's risky or hard to do, just put your money in index funds. Just put it in index funds and you'll be fine, right? You hear that a lot, which I think is, good, better, best in personal finance in terms of advice. But I think that's generally a pretty good, advice to give somebody, even though it's pretty general. Anyway, I want to get into, like, is that really the smartest and best thing, though, that you could be doing with money, is just putting it into index funds. So the most popular index in the entire world, our listeners probably know this, is the S&P 500, right? The S&P 500 are the 500 biggest companies in the United States. That's the index there. The three largest index funds, or even mutual funds, just overall in the world, like, so the largest meaning the most money invested in them, they all are U.S. index funds. Like, number one is Vanguard's Total Stock Market Fund. Number two is Vanguard's S&P 500 index fund. And number three is Fidelity's 500, S&P 500. So the three largest funds in the world are these S&P 500 funds, essentially. And so, but the question is that really the most diversified, optimal place for your money? Recently, I think you could argue that that's not the case. For example, if we look at the 10 largest stocks in the S&P 500, right? So there's 500 in this index. If we're looking at the 10 biggest ones by market cap, right now, those 10 stocks make up almost 40% of the entire index, just those 10, right? So 10 make about 40, the other 490 make up the other 60% essentially. That is kind of crazy. So when we're saying like, oh, you're getting access, like an index fund is touted as you're getting this huge basket of stocks, it's really diversified. Right now, what you're really buying is a handful of big tech stocks. Like that's really what the index has become over the past couple of years. For some context here, then I want to hear you guys chime in. If like it was 40% normal, is that crazy? If we go back to 1990, the top 10 stocks made up about 21% of the total index in about 1990. If we look back over the past, 30 or so years, I'm just looking at a chart here. The number, like the weight of the top 10 bounces around between like 18% to 25%. Like it got up to 25% in the year 2000, then it dropped down again. But it's around that like 18 to 25 is about where those top 10 usually are. And since 2018, 2016 range, that's just taken off. Like it's just skyrocketed here. We're now again almost at 40%. So these ultra huge mega stocks, mega tech stocks are just becoming more and more of the S&P 500, where much of the performance of that index is really just those big stocks. I don't know, thoughts on this, guys? Any thoughts?
I can't imagine Robbie has any thoughts on this.
It's just worrying. I guess let's ask this, like, Robbie, are you worried about this? Is this something that's concerning to you or not really?
Not as much. First of all, I have a couple of talking points about this.
Yes.
The first one, as you were talking, I pulled up on my dashboard comparison between the S&P 500 index that we know. It is market value weighted, aka it's the size of the company that determines what percentage of the allocation it's going to be. And there's another S&P 500 index which is equal weighted. We call it naive diversification, where every single stock has the same weight. So everyone is 1/500. That's their ratio. And over the last 3 years, the weighted index has made 17.65% cumulatively, whereas the S&P 500 has made 35% cumulatively. So almost half of the return can be attributed to these, bigger stocks. And over the last year, so we're talking from like mid-January till mid-January, 18.9% for the equal weighted and 27% for the S&P 500. So the fact that you might be telling people, hey, the S&P 500 isn't diversified anymore, they'd be like, but so what? Most of the return is coming from these companies. Why would I want to eliminate them? Another good argument for why it shouldn't be a worry is that the reason those are a big percentage of the index is not due to speculative movement or a bubble emerging. Those companies, mainly the Meg 7, the top 10 holdings in the S&P, their profit margins are like 2.5 times the profit margins of the remaining companies in the S&P 500. The percentage of bankrupt companies is much lower in large cap than in small cap. So unlike periods like in the tech bubble, etc., where those valuations were unsupported by fundamentals, this time around, there is a reason for why they are priced as high as you said. So if you ask me, do you think Apple, maybe not NVIDIA, but like Apple, Microsoft, Amazon, Facebook right now are overvalued, fair valued, or cheap undervalued? My best guess is like they're fairly valued. So if they're individually fairly valued, why is it that when we want to put them in an index, we think they are overvalued and they are expensive? There is fundamental reasons for why they are expensive. I do not think it's the market that's forcing them to concentrate the index as much as their business model is concentrating the industry. It's not related to the stock market, in my honest opinion. I think it's related to how the tech sector as a whole and its bylaws and antitrust laws have allowed companies to get this big. Their value is reflective of, they are the most followed companies in the world. It's not like a bubble, or the value there is very accurate. It's just, why did we just heard that, the SEC is breaking up Google's search engine? Why are we seeing these emerge? It's because probably in their industry, those companies have eliminated other competition, and the fact that they are in that position where they do not have competition is reflected in their price. Last point, sorry, I went on that spiel. From a perspective of a portfolio manager who is managing money, holding the S&P 500 a couple of years ago, you would expect, due to the weight of each company in the index, to probably expect a large drawdown of 50% on the index, right? Just like in 2008, the S&P 500 dropped 50% before closing the year at negative 34%. Now with the concentration, that drop might be much more significant, aka you might see 70, 80% drops, because those individual stocks on their own will drop by that much. And we know if you lose 50% of your money, you need 100% to make it back. But if you lose 80% of your money, maybe you need 240% to make it back. So it's a much, much harder climb upwards. So from a risk management perspective, you might want to try to work against that allocation. Be your own government in the portfolio, aka break them up, rather than just follow them with the return going forward. But if you're able to stomach it, the companies themselves are still in a good position.
Yeah, I love the angle you took there, Robbie, to start. And then the last part you said there was exactly what I was thinking about when Jake was going through this and we talked before we went on, was more just from a place of, like, Robbie, you're hitting, like, the mechanism for this is explainable, right? And it's not like this is some massive bubble. They're profitable. There's other reasons why they got this large. I was more thinking about it from a place of, like, truly from coming back to the question, is the S&P actually diversified anymore? I like how you started this, Jake, of saying good, better, best. If we're out there talking to most people, the vast majority of people, should you be trading individual stocks or just own the S&P 500? We're still going to tell people
it's more diversified.
It's more diversified, and it's a better strategy for 99% of people. But is it the most optimal strategy? Is it the best strategy? We don't believe that. We have a different approach to this. We don't believe in to be truly diversified, to truly manage the right amount of risk, to truly have a long-term view. We do not believe, like, just buy the S&P and sit there. We have a passive philosophy, but we have an active application of that. So that, I know that's kind of sounds like, okay, what does that even mean? That would be a whole other multiple hour podcast. But we believe more in systematic investing, not passive investing. So this is the other thing I was thinking about, last point on this, and I'll throw it back to you guys. I was thinking of somewhat of the flaw in index investing. Like, this is what can happen if you allow, and people think, like, people don't realize what a index fund actually is. And there's actually policymakers. There's actually like a board of humans who are on that, who actually have to follow and adhere to certain rules and put certain stocks in, take certain stocks out based on the rules of that index. So it's not exactly like as passive as you might think. And there's a little bit less control than if you have more of a systematic approach. So I think we're just highlighting some of the risks here of this can happen. Even though it's explainable. But Robbie, to your point, the other side of this coin is you might be reaping the benefits now, but when things come back down and you're that concentrated in big tech stocks, it can hurt you even more if you're that concentrated. Any other final thoughts on this, Jake or Robbie, on that?
I did want to throw out just a few more historical things about these large cap stocks, right? The reason they've grown, like Robbie said, the underlying fundamentals of these companies are great. The reason they're taking up such a huge portion of the S&P 500 is because they've just grown a ton, right? Over the past, since 2019, Ben Carlson has this, like, what was the best performing segment of the market, over the past year, and he does it for like the past 10 years, and he has these charts. Since 2019, large cap stocks in the US have been the highest performing segment of the market 4 out of the past 5 years, right? So that's why, they keep going up and going up and going up. And so that's why they've dominated this market and people want to invest in them. What I find is interesting is if we don't go back 10 years, but go back to the year 2000, from 2000 to 2010.
So glad you brought this up.
Large cap stocks, actually during that period, over that decade from 2000 to 2010, were never the highest performing segment of the market. In fact, over that 10-year period, they were the lowest performing sector, the lowest. They had a negative return over those 10 years.
That's the infamous lost decade.
Yeah, so it's like, I know the past 15 years have been great for large U.S. stocks. We always are questioning, is this going to flip at some point? One of the underlying rules of the market is nothing lasts forever, right? Everything is cyclical. Now, cycles can last for a long time. We don't know exactly when they're going to end, but I always am just questioning, is this bull run for huge tech stocks going to end at some point? We'll see. You know what? Just a quick aside. I think Rob is going to like this. I'm looking at this 2000 to 2010 chart. Emerging markets were insane. over that decade.
12%
In
annualized.
2003, there was a 56% return, a 68% return, a 33% return. Emerging markets, man, like that's like they're dead now, but like over that 10-year period, those were amazing. Anyway, I just think it's interesting to highlight some of that stuff. Do you want to know what was the best performing asset class over that 2010? Real estate. What happened to real estate at the end of the 2010s? There was a pretty big, anyway, we can draw some assumptions or whatever here, but we'll see how this large cap, these stocks just keep going or not into the future.
Yeah. Robbie, you have thoughts on that? Final thoughts?
Final thoughts, just to answer Jake's question, like when is it going to end, the large cap? It's not that I know, but it's more likely going to happen from the actual economy, a change in technology, a change in our lifestyle, just like we moved to living online rather than, the market just decided to sell off, right? Houses in 08 did not crash just because mortgage-backed securities have been overbought and oversold. No, it was because people started defaulting because they weren't being sold the right houses, etc. So it always comes from something more concrete, more on the ground, something more related to the economy than it is just the, ups and downs and moods and swings of the stock market.
Yeah, love it. Yeah, this is awesome, guys. As always, thanks for sharing your wisdom. Everyone, if you're listening, if you're still listening, first of all, thank you. Thank you for hanging in with us. We appreciate it. Hope you're having a great weekend. We want to talk about, again, an incredible event coming up June 20th and 21st, the Dentist Money Summit, our second annual Dentist Money Summit. It is going to be an incredible event, full new slate of speakers, Park City, Utah. It's going to be amazing. We did a live 2 cents last time. I don't know if we're doing that again this year, but you do get to still come and meet the great Jake and the great Robbie and the whole Dentist Advisors team, along with our amazing speakers. So we encourage you to go check it out. If you have any questions, let us know. But you can also just go to dentistmoneysummit.com. We'd love to see you in Park City. For now, that was our 2 cents. Thank you so much for listening. Have a good weekend. Bye-bye.